A lot of you dividend investors are looking for some ETFs with the highest dividend growth, so that is exactly what I'm going to be giving you in this video. I'm going to be giving you 3 dividend ETFs with the highest dividend growth. I'm going to be going over their investment methodologies, their holdings, and their dividend growth history. Before we get into the 3 ETFs, I am going to be giving you a little bit of a caveat. There are ETFs out there that have a short history of dividend growth, like QQQ, for example, but since the dividend growth history is not constant, I am not going to be including those ETFs in this video. So with that being said, up first on this list is the popular DGRO, the iShares Core Dividend Growth ETF, a very popular dividend ETF out there among dividend investors. And the investment methodology of this ETF is pretty simple. It seeks to track the investment results of an index composed of U.S. equities with a history of consistently growing their dividends. So as simple as it gets, it wants to include companies that have grown their dividends year over year. The ETF does have a decently low expense ratio for what it does, sitting at 0.08%, which puts it among the lower expense ratios among ETFs in general. Overall, this ETF does have a very diverse set of companies that it holds, sitting at 407, and it has a 30-day SEC yield of 2.3%, which is decent among dividend ETFs. It's not either high or low. This ETF is also decently diverse among industries, with its top holdings above 10% being financials, information technology, healthcare, consumer staples, and industrial. So you definitely do see some of the more well-known industries when it comes to dividend investing up there, like financials, healthcare, and consumer staples, but it also does have this information technology holding as well, which definitely does allow for some growth in this ETF. And the top 10 holdings are all very well known among dividend companies in general, with JP Morgan Chase, Broadcom, ExxonMobil, Johnson & Johnson, Microsoft, Apple, AbbVie, Procter & Gamble, Home Depot, and Merck. And all of these stocks, of course, because this ETF invests on the methodology of consistently growing their dividends, these companies also do have a good history of growing their dividends. And if we go a little bit further, which each of these holdings weighted above 1%, we do see some other popular dividend companies in the top 20 in general. So this is going to be the top 11 to the top 20th holding, with Coca-Cola, United Health Group, Pepsi, Bank of America, Cisco Systems, IBM, Morgan Stanley, Amgen, Citigroup, and McDonald's. So pretty much the same with the top 10. All of these companies have a great history of dividend growth. And as you can see by these companies, it is a very diversified group among industries as well. And if we do look at the historical performance of this ETF, it debuted around 2014. And since that time, with those dividends reinvested, it has increased in price by about 220%. So good growth, good dividends, companies, and also a decent yield. Now, with all that said, the ETF has offered a dividend growth history of 10 years and a pretty good dividend growth for the previous 5 years, coming in at an average of about 8.3%. So that is the pretty quick summary of the dividend ETF, the iShares Core Dividend Growth ETF, DGRO, or DGRO for short. Next up on the list is the most popular dividend ETF out there, VIG, the Vanguard Dividend Appreciation ETF. This is also the largest holding that I have myself, and it has a bit of a lower expense ratio than DGRO, coming in at 0.06%. But it also has a lower SEC yield, the 30-day, coming in at 1.69%. So even lower than DGRO, but when it comes down to it, it does hold a better quality companies when it comes to capital appreciation. This ETF does offer a slightly lower number of holdings than DGRO, coming in at 337, but nonetheless very diversified with that number of companies. Now, the industries of this ETF that come in over 10% is slightly different than DGRO, with information technology being the largest holding and financials coming in at the second largest. Remember, with DGRO, that was flipped around, but we also have other industries as well above 10%, such as consumer staples, healthcare, and industrials. So pretty well diversified ETF when it comes to dividends in general or companies in general. Taking a look at the top 10, now this ETF does have some of the same companies that DGRO has, but it does have a bit of different weightings. Remember, because information technology is a bit of a bigger holding of this ETF. You have Broadcom, Apple, Microsoft, JP Morgan Chase, Visa, ExxonMobil, United Health Group, MasterCard, Costco, and Procter & Gamble. And if we look at the 11th to 20th largest holding, because we want to see what all the holdings are that have a weighting above 1%, we have Walmart, Home Depot, Johnson & Johnson, AbbVie, Bank of America, Oracle, Merrick, Coca-Cola, Cisco Systems, and Accenture. Now looking at this ETF, it has been around longer than DGRO, coming in at 2006, and since then it has a total return of about 471%. But if we look at the 10-year, it has a total return of about 194%. And based on that, if this graph is exactly equal to the dates, this ETF DGRO did slightly outperform VIG in general. So just a note there, even though VIG does capture some companies that do seemingly have a better anticipation for capital appreciation, it does look like DGRO did slightly beat it out. And that is, of course, assuming that these dates are equal from when this chart was made and when VIG did this 10-year prior history as well. Now, this difference is not massive, but it's definitely something to note that DGRO, at least in this example, did outperform. Now, with the dividend growth of VIG, it has a dividend growth history of 11 years, so it slightly beats out DGRO by 1 year, but it has also been around longer. Now, the 5-year dividend growth rate of VIG does beat out DGRO by about 8%, coming in at 9.63%, so solid dividend growth overall, and of course, a solid group of companies. So that is the quick summary of the dividend ETF VIG, the Vanguard Dividend Appreciation ETF. Overall solid ETF, and remember, it is the #1 dividend ETF based on assets under management, extremely popular. And part of that popularity is because it seeks to track the performance of the S&P US Dividend Growers Index, a very popular dividend index. And the reason why it's so popular is because it is designed to measure the performance of U.S. companies that have followed a policy of consistently increasing their dividends every year for at least 10 consecutive years, and then it excludes the top 25 highest yielding eligible companies from that index. So again, it wants companies with a great track record of dividend increases, but then it also excludes high-yielding dividend companies. You're going to see that it doesn't include things like Verizon or AT&T or other very high-yielding dividend companies overall. And finally, up on this list, you are going to get the Schwab US Dividend Equity ETF, or SCHD. This is an extremely popular dividend ETF. Now, while VIG is the most popular dividend ETF based on assets under management, I think SCHD definitely beats it on media popularity. You hear about this ETF everywhere, and of course, for good reasons. It has a low expense ratio of 0.06%, and the idea of this ETF is to track the total return of the Dow Jones US Dividend 100 Index. And this index is a bit different than DGRO's or VIG. This one includes high-yielding dividend stocks in the US with a record of consistently paying dividends and then selected for their fundamental strength relative to their peers based on financial ratios. So you're going to get three things. You're going to get high-yielding dividend companies. You're going to get companies that have a record of consistently increasing their dividends over time. But then from that group of companies, this ETF and the index in general screens those companies against their peers based on financial ratios, so you get the best of the best companies. And since this ETF includes those high yield companies, you are going to get a higher dividend yield than the previous two, coming in at 3.72%. So about a 1% difference than even from DGRO. Remember though, this ETF definitely focuses on higher dividend yielding companies, and you'll see that from the list of companies that it holds. Speaking of the total holdings of this ETF, it comes in at 103, but if you look at the total holdings from the fund page, it has holdings in there that aren't necessarily companies, but it reports on those anyway. It includes things like cash and also other minute things that basically makes no difference. So the true total number of holdings truly tracks the Dividend 100 Index, coming in truly at 100 holdings. Unlike DGRO and VIG, this definitely has a focus away from information technology. Remember, with the previous two, information technology was in the high teens or low 20s, but this one has it at 8.8%. It doesn't even come in at 10% of the overall industries that this ETF holds. You have all of the industries that are over 10% as financials, healthcare, consumer staples, industrials, and energy, with several other industries coming in below 10%. Speaking of the top 10 holdings of this ETF, you do see some crossover with the previous DGRO and VIG, but not as much, again, because these industry it tracks is different. So you have Pfizer, Chevron, Cisco, Coca-Cola, AbbVie, Amgen, Bristol-Myers Squibb, BlackRock, Home Depot, and Texas Instruments. And the thing about this ETF is that it tries to weight at around 4% at its highest holding. So you're not really going to see really top heaviness in this ETF. And because of that, it's going to take a lot longer than the top 20 to get down to the holdings that are above 1%. So I am not going to say them all because it will take a little while, but if you do kind of slow the video down or pause it, you will see all of the holdings that are above 1% of this ETF, and it does have a solid list, with companies like Fifth Third being the last company with a greater weighting than 1%. Now, with SCHD's total return for the prior 10 years, it comes in at 205%. Very solid total return, and remember, you're also getting that high dividend yield with that total return as well. And then finally, which is why this ETF is the number one ETF on this list, you do see a great history of dividend growth coming in at 13 years, and you also have a great 5-year average dividend growth rate coming in at 11.6%. Part of the reason why this ETF is so popular is because it does what a lot of other ETFs don't do. It combines dividend yield and it also has dividend growth, which is uncharacteristic of a lot of other dividend ETFs out there. You usually have one or the other, but with SCHD, you get both. That is the quick summary of SCHD, the Schwab US Dividend Equity ETF, the most popular, again, I would say, media ETF out there. It is spoken about widely on YouTube, on Google, on various other finance forums. It, of course, is probably so popular because of what I said. It combines dividend growth with dividend yield as well. And just to kind of show you a little bit of proof that I do think that these ETFs are great as well, I do have VIG coming in at about $46,000 in my portfolio, and then I also have SCHD coming in around $20,000 of my portfolio as well. So again, I do believe in these ETFs. I think they are great ETFs in general, and dividend ETFs as well. Please remember, if you did appreciate this content, give this video a like to get this content out there to a wider audience. And also, if you did enjoy this content, subscribe to keep up to date on future videos, and I will see you all in the next one.